peak oil and oil prices. Who's to blame? So now, despite a finding by federal regulators that speculation is not to blame for high oil prices, the U.S. Senate recently voted 94-0 to proceed with legislation to curb speculation. Such apparent contradictions are typical of the speculation controversy. Everything's been turned upside down. During congressional hearings over the past 3 months, securities people and money managers have insisted that speculators have pushed oil prices into the stratosphere. On the other hand, economists with the Commodity Futures Trading Commission and the New York Mercantile Exchange, Federal Reserve Board Chairman Ben Bernanke, the International Energy Agency and investment superstar Warren Buffett agree oil prices are what they are because of constrained supply and ever increasing demand. Or how about this? All the cheap oil is gone. It's in hard to get places, or it's in deep water out in the oceans, where you have to have huge drilling platforms, which cost a lot of money. Maybe there's a number of reasons. Yes, supply and demand. With expert opinion so divided, what is a consumer? What are the poor people supposed to think? Well, it could be a number of factors, couldn't it? Or, it's very confusing, isn't it? It's called confusion of faces. The confusion begins with the word speculation itself. It's a kind of hot-button word that pundits and politicians throw around all the time. But does it really mean anything? Or is that just another way to confuse people? Cambridge Energy Research Associates Chairman Daniel Yergin, in written congressional testimony, said that while in the popular mind a speculator is a manipulator, all a speculator does is try to anticipate the future price, in this case oil, and theoretically make a profit on the move. This is distinguished from what the Commodities Futures Trading Commission, which regulates futures contract trading, calls commercial activity, also known as the trade by market players. Oil companies, refineries, chemical companies, and other businesses that deliver or take delivery of oil are the trade. In other words, capitalism at its best, or at its worst, however you want to look at it, huh? Experts say the sometimes extraordinarily complicated deals that make up futures trading are simply impossible without the willingness of speculators to bet on the direction of oil prices. Buying, selling, and speculating. Yes, capitalism. Both speculators and the trade buy and sell contracts that obligate one side of the transaction to deliver a set quantity of oil, or corn, or wheat, or gold, or just about anything else at a set price at a specific date in the future. A refiner needing oil to make gasoline might want to guarantee that it will pay no more than a certain amount for oil 6 months from now, no matter what the spot price is at the time. So it will buy a contract that nails down the price it will pay in 6 months for a specified quantity of oil. If oil in 6 months can be bought for a better price than the contract secures, the refiner will buy the oil at that spot price and let the contract expire. If the spot price goes higher than the price set in the contract, the refiner will exercise its right to buy the oil at the contract price. So, the process works in reverse too. An oil company might want to make sure it can sell oil for a certain minimum price in the future, and will buy a contract to lock in that future price. If it can sell oil for more when the contract comes due, it ignores the contract and sells oil at the spot price. Is any of this connected? Yes, this is very confusing. Why options markets exist? The reason that options markets like these exist is to help commercial traders like refiners and oil companies transfer some of their risk to speculators, said a Dallas company that helps a trade reduce its exposure to price volatility. Without speculators, there is no futures market. The refiner reduces the risk that prices will rise by buying a contract. If prices declined, the refiner is out only the cost of the contract, which is trivial compared to the potential future price of oil. So, the speculator took the risk of guaranteeing oil will be delivered even if the price goes higher. Speculators are theoretically just making a bet. If they're right, they win. If they're wrong, they lose. They don't have any riskless way to manipulate price. Many of these trades occur at the New York Mercantile Exchange, which is a building in downtown Manhattan. Trades can also occur online and at the ICE in London. These trades have been taking place for many years now, and mostly no one but investors and economists and regulators think about them. But now they're showing up on the TV, on the radar, in the political jargon, on the talk shows. You know what I mean. Escalating oil prices have changed that. Now, at about the same time prices rocketed higher, non-commercial trading on oil and other commodities increased dramatically. The Commodities Futures Trading Commission said that open interest, the number of contracts that haven't been fulfilled or expired for West Texas Intermediate crude oil futures, tripled between 2004 and 2008, May 2008, to 3 million. So they say some of that increase is because many new players with a range of motives have joined the commodity markets. Is this about greed? Yes, it could be about greed also. And capitalism. Pension funds are buying commodities or dealing in options to diversify their portfolios away from stocks and bonds. That reduces long-term price volatility of their total holdings. So theoretically, people are also in commodities to hedge against inflation risk and the risk of the falling U.S. dollar, or to bet on economic growth in China or India, which is spiraling faster and faster. One senior oil analyst, told a U.S. House committee in June that supply and demand don't justify the high oil prices. After all, he said, demand growth in China, India, and other developing countries was not a surprise and was reflected in crude oil futures a year ago. There were no unexpected changes in industry fundamentals in the last 12 months when crude oil prices were below $65 per barrel. So he said he cannot think of any reason that explains the run-up in crude oil price besides excessive speculation, which equals greed. A task force formed by the CFTC to evaluate oil speculation came at the problem from a different direction and reached the opposite conclusion in another report issued in late July. This is all very confusing. Very confusing the way I see it. So, why is the price of oil so high? Could it be that all the cheap oil is gone? Is it speculators? Is it supply and demand? There seem to be many reasons, depending on how you look at it. Anyway, these are all more signs of the end times transition days, and there are many signs.